Here is a question that comes up constantly in precious metals conversations. If platinum is rarer than gold in the Earth's crust, why does it cost less? And does that gap make it a smarter buy? The answer is more nuanced than it first appears, and understanding it will help you think more clearly about both metals. Gold and platinum are both real, tangible assets, but they behave very differently, and they respond to very different forces in the market. Gold's value is rooted in monetary history and investor psychology. Central banks hold it as a reserve asset. The World Gold Council reports that central banks, particularly in emerging markets, have been net buyers of gold for several consecutive years. That consistent institutional demand creates a meaningful floor beneath the market. Add in investment products like coins, bars, and ETFs, plus ongoing geopolitical uncertainty, and you have a metal whose price drivers are relatively well understood and stable. Gold trades more like a financial asset than a raw material. Platinum is a different animal entirely. It is part precious metal, part industrial commodity. The bulk of platinum demand comes from the automotive sector, specifically catalytic converters in diesel vehicles. That means platinum's price is sensitive to manufacturing trends, emissions regulations, and global economic growth in ways that gold simply is not. For much of the 20th century, platinum actually traded at a premium to gold. That relationship flipped after the 2008 financial crisis and has remained inverted for much of the time since. Some analysts describe the current gap as a potential buying opportunity, the logic being that the ratio could eventually revert toward its historical norms. But that is not guaranteed. The World Gold Council and commodity analysts have noted that the shift happened for structural reasons, particularly the decline of diesel vehicles in Europe. Past price relationships do not promise future ones. Where platinum does have a compelling forward-looking story is in the hydrogen economy. Platinum plays a critical role in hydrogen fuel cells. If green hydrogen adoption accelerates, demand for platinum could increase meaningfully. Supply is also geographically concentrated, primarily in South Africa, making the market more vulnerable to disruptions. Unlike gold, which has large above-ground stockpiles, platinum's reserves are thinner. That makes it more reactive to supply-demand imbalances. But, and this matters, those catalysts may take years to develop, or they may not develop as expected. Platinum carries higher price volatility than gold. Investors considering it should be comfortable with that and think in terms of a longer time horizon. If your priority is capital preservation, liquidity, and a proven track record across different economic environments, gold remains the more straightforward choice. If you want exposure to potential industrial and clean energy upside, and you can tolerate more volatility, platinum may complement a gold position rather than replace it. You can compare current inventory and live pricing for both metals at absolutebullion.com. Whatever direction interests you, speak with a qualified, licensed financial advisor before making any decisions. Education is the starting point. Personalized advice is what makes it actionable.